Investment. When a big IPO like Gemini hits the headlines, investors immediately get that fear of missing out. After all, crypto is exciting, and exchanges like Gemini represent the picks and shovels of this digital gold rush. But before throwing money into the IPO, let's step back and look at the bigger picture. IPOs are designed to raise money for the company, not to guarantee profits for investors. That means the opening price is often inflated by hype, making it easy for early buyers to overpay. History has shown us that most IPOs, no matter how promising, tend to drop after the excitement fades. In investment, the risk of buying too early is simple. You could end up paying the highest price just because you didn't want to miss the train. Take a look at Coinbase. When it debuted, excitement was through the roof. Investors who bought on day one ended up losing half their value in just months. Why? Because the fundamentals couldn't keep up with the hype. Gemini could easily follow a similar path if you rush in without a plan. But IPOs reward patience. More often than not, waiting a few months gives you a much clearer entry point and a better deal. Now, that doesn't mean Gemini isn't worth watching. The exchange has strong branding, investment, a reputation for compliance, and could benefit from increasing crypto adoption. But we can't ignore the challenges. Competition is fierce, with Coinbase, Binance, and Kraken already owning massive market share. Plus, regulators are still circling the crypto industry. If new rules clamp down on exchanges, profitability could take a major hit. So yes, Gemini has potential, but there are also real risks that could affect its long-term growth. So what's the smarter play? Don't chase the hype. Instead, wait for the valuation to settle, analyze earnings, investment, and look at the bigger cycle of crypto. If the market corrects, and history suggests it likely will, that's when disciplined investors can buy in at a discount. Remember, wealth isn't built by following the crowd during moments of excitement. It's built by staying calm, waiting for opportunity, and buying when fear replaces greed. Gemini's IPO might become a great investment, but only if you treat it as a long-term play, not a quick lottery ticket. When it comes to IPOs, one of the most important things to understand is the difference between hype and reality. Every time a big company announces it's going public, excitement surges, and the media builds it up as the next big opportunity. This creates what's known as IPO hype, sense that if you don't get in right away, you'll miss out on something huge. But the truth is, most IPOs are structured to benefit the company and its insiders, not the average retail investor buying on day one. The price is set high because underwriters and early backers want to maximize their returns, and the public gets caught up in the frenzy, often paying a premium that isn't justified by the company's actual performance. Think about it when you buy into an IPO. I think good investment, you're not necessarily buying at a fair price. You're buying at the most optimistic projection of what the company could become. That means a lot of future growth is already baked into the price. If the company doesn't immediately meet those lofty expectations, the stock can quickly fall, leaving early buyers underwater. We've seen this pattern repeat itself countless times across industries. Investment. From tech startups to crypto-related companies, the initial hype fuels demand, but once reality sets in, the stock tends to correct downward. For Gemini, this hype factor is even stronger because it's linked to cryptocurrency, a sector already known for volatility and speculation. Investors who jump in just because it's a hot IPO risk buying into inflated valuations without considering long-term fundamentals. The smarter move is to separate the excitement from the actual value of the business. Understanding that hype doesn't equal profitability is the first step to avoiding costly mistakes. Investment waiting for reality to catch up often provides better opportunities. The risk of buying too early in an IPO is something that catches many investors off guard. When a company first goes public, there's often so much excitement that people rush to buy on day one, thinking they'll ride the wave up. But history shows that IPOs rarely work out that way for early buyers. More often than not, the stock price spikes in the first few hours or days, and then starts to slide as the hype fades and reality sets in. Those who bought at the top end up stuck with losses. Investment, while those who waited patiently often get a better entry point later on. Take Coinbase as an example. When it went public, the buzz was massive. Everyone believed it was the future of crypto exchanges, investment, and investors rushed in on day one. But instead of continuing upward, the stock lost nearly half its value within months. That wasn't because Coinbase was a bad company, and it was because investors overpaid in the initial frenzy. Gemini's IPO could easily follow a similar trajectory. If you buy too early, you risk paying the highest possible price. essentially locking yourself into losses until the stock recovers. The psychology of the market also plays a big role here. Early investors are driven by fear of missing out investment, while institutional investors and insiders, who often got in at far lower prices, take the opportunity to cash out some of their holdings. That dynamic usually works against small retail investors. By waiting investment, you allow the hype to die down, analysts to publish real earnings reviews, and the company's actual value to emerge. In other words, patience isn't just a virtue. It's often the difference between investing at a discount and becoming someone else's exit strategy. Gemini's position in the market is unique, but it's also complicated. On one hand, Gemini has built a reputation as one of the most regulated and compliance-focused crypto exchanges. And this has given it a level of trust with both institutions and everyday investors that some competitors struggle to match. The Winklevoss twins, who founded the company, have worked hard to brand Gemini as a safe and transparent platform in an industry often criticized for being risky and unregulated. That credibility is a big asset, especially when you compare it to exchanges that face frequent legal challenges or operate in gray areas. For investors, that sense of stability could make Gemini an attractive long-term play. However, Gemini is entering an arena that's already extremely competitive. Coinbase is still the dominant US exchange. Binance continues to attract massive global trading volume. And Kraken has carved out its own loyal user base. For Gemini to thrive, it has to not only compete on fees and services, but also innovate in ways that differentiate it from bigger players. This isn't an easy task. At the end of the day, crypto exchanges make money from trading activity, and that revenue depends on overall market cycles. If crypto enthusiasm slows down, even the most trusted exchange will see revenues shrink. Regulation is another factor that could make or break Gemini's future. On the positive side, being ahead of the curve in compliance could give Gemini an edge if governments crack down harder on the industry investment. But on the flip side, stricter rules could also limit growth and profitability. For investors, this means Gemini carries both opportunity and risk. Its strong reputation sets it apart, but success will depend on how well it navigates competition, regulation, and the natural volatility of the crypto market. The smarter long-term strategy when it comes to IPOs like Gemini's is to avoid chasing hype and instead focus on fundamentals. Too many investors treat IPOs as a lottery ticket, hoping to strike it rich overnight investment, but the reality is that sustainable wealth is built through discipline and patience. The goal isn't a good investment guess what the crowd is excited about today. It's to figure out whether the company's value will compound over the next 5 or 10 years. That requires asking hard questions. What are the earnings? How scalable is the business model? How strong is the competitive moat? And most importantly, is the stock price fairly relative to its potential? Timing also matters. The crypto industry, in particular, moves in cycles of booms and crashes. During bull runs, valuations can become inflated, making it easy to overpay for growth that may not last. Good investment. But during downturns, when fear dominates, great companies can be picked up at bargain prices. Waiting for those moments isn't about missing out. It's about increasing your odds of success. Investors who learn to separate emotions from strategy often outperform those who chase excitement. With Gemini, the smarter play isn't to jump in the moment it goes public. Instead, it's to watch closely. Let the market digest the IPO, see how the company reports earnings, and monitor how regulators shape the industry. If the stock corrects after the hype wears off, a good investment, that's when disciplined investors can step in with confidence, knowing they're buying closer to fair value. In the long run, good investment, avoiding emotional decisions and sticking to fundamentals is what separates successful investors from those who lose money. The key lesson here, investing isn't about being first. It's about being right.